Hi friends, this is my third lecture on credit risk measurement and management. During the previous lectures, I was just explaining what is credit risk, what are components of credit risk, and computing risk return trade-off, etc. Now let's go to types of credit facility. Credit facilities can be broadly classified into two: retail facility and wholesale facility. Retail facilities customer-oriented services. These are we are offering directly to individuals in the form of B2C process. Means we are serving the customer directly. It can be in the form of mortgage loan. Mortgage loan is also known as LAP loan. LAP loan is loan against property. We are providing loan against a particular property as a collateral. Then personal loan. Personal loan is a non-unsecured loan. It is given based upon the credit history of the borrower. Debit cards, credit cards. Credit card is also an unsecured loan. We are giving based upon the past history. Debit cards is nothing but what do you call facility that is given to the customer based on the it is nothing but normal account where we they can withdraw money that is in the account itself. That is not a working capital facility or a term loan facility. That's not like there is no. It is purely an account, bank account, where customer can withdraw from the bank account. Then small equipment loan. These are all called as retail facilities and wholesale banking facility. This meant for large corporates, small medium enterprises, real estate developers, international trade finance. All means this is purely for the purpose of business. We are serving the business, so it's a B2B transactions. What we'll provide there, we'll provide term loan facilities, we'll be providing working capital facilities, we'll be providing export packing credit, packing credit in foreign currency, etc. These are all wholesale banking because we are serving the not we are not serving the what do you call retail customers. We are not serving the normal customers, but we are serving the wholesale customers or business customers. So just credit facilities, I just classified into retail and wholesale, and it can be also classified based on whether outflow of fund is there or not, and that is fund based and non-fund based. What is fund based facility? By the name it says it is facility where actual outflow of fund happens. For example, when we provide a working capital facility, when we provide a CC, we provide the money and they should repay us. When we provide OD, when we provide term loan, everywhere we give them money at the beginning and they will repay when time comes. There are certain facilities where we don't, there is no fund outflow, where money is not going out. For example, that is bank guarantee. Bank guarantee, we give a guarantee that Mr. A third one person, if he fails to pay, we will pay. Here, we won't pay to the party unless the main party does not oblige. They don't repay the obligation. So this bank guarantee is normally taken by contractors. This because when they go for a tender, they need a guarantee from a trusted source. So that's where bank comes. Bank gives guarantee so that if contractor fails, then bank will reimburse. That is a form of bank guarantee. Similarly, letter of credit is another form of non-fund based facility. Fund-based facilities, certain examples we'll be going through. First one is personal loan. Personal loan is an unsecured facility, a customer loan based upon the track record, based upon how borrower history. We'll be checking the borrower history from the CIBIL report or other bureau reports. We'll be checking their bank account transactions, and then we'll be finding out whether this person is genuine or not through KYC and all, and then we'll be providing the loan. So it's a unsecured loan given to the customer. Ability to repay loan from personal income. So how will we checking the personal income? We'll be checking from IT or on different sources. We'll be checking what is the income sources, and based upon that, we'll be providing the facility. Normal repayment will be a fixed amount of installment, also known as EMI. Means that EMI will be consisting of both principal and interest. Of fixed term will be the repayment. Then second is mortgage loan or home loan, also known as LAP loan. This is Loan secured by property or real estate is mortgage loan. So a person building a home, they will be giving us the land as a mortgage. They will also give some other properties also. This is so whenever they give some property as collateral, then we'll consider it as mortgage loan. Here it's a brief description of how mortgage loan function. A customer, in this case, customer purchases home or constructs home from a constructor or a contractor or a seller. If it is, let's first assume there's a purchase, not a construction. In case of purchase, customer what they do, they will purchase home from the contractor. How they will get the money? Customer may be having a land, but they may not have. Sorry, that is in case of construction. Customer will have to purchase a home from a say like seller. In that situation, what he'll do, he had to pay money. He doesn't have money, so what he'll do, he will approach a bank. Bank will not give money without any collateral. So what they'll do, he will take the same house that is proposed to be purchased as collateral, then get the money, and this money will be used for paying as consideration to the seller or constructor. The same situation happens for construction also, where he will be giving the land as collateral to the bank, and that will be the process here. So here, what he does is he gives the property as mortgage to the bank and gets a fund for paying consideration and pays the money to the seller or constructor. That's the form of bank facilities, working capital loan. Just 1 minute, I'll just reduce the screen. Yeah. This is working capital loan is compared to term loan, compared to lab loan. This is not paid based on installments. This is here in working capital loans. Normally, what they will be expecting is only we'll be expecting to repay interest during the period of working capital facility. We will not expect them to repay the principal. So this is for financing everyday operations of the company. This facility will not be used for buying long-term assets or investment. This will be used for short-term needs. Means what is a need for repay for buying materials? They need fund. So it will be used for paying suppliers. Basic normal operations of the company will be met using working capital facilities. How we will be computing the requirement of working capital? There are three methods of assessment based on tandem committee that we is called method one, method two, method three. First, we need to understand what we are funding. We be funding working capital gap. What is this working capital gap? Normally, for normal business operations, we have a working capital cycle. That is, we have money that will be used for purchase of materials that materials we have that materials what we'll do, we'll process, we sell, and we'll realize for the customer. Suppose we in all this process takes some time. Suppose we have debtors, we have we when we sell, it will take time for realization. Suppose it takes almost 90 days for realization, and it takes almost 30 days for processing. So 90 plus 10, 30 days. So 90 plus 30 is 120. 120 days it will take for realizing the money, because stock is lying for 30 days, and after selling it will take 90 days for realization. So customers suppliers won't wait for that time. So suppose we need to pay the suppose we can assume in the situation they are not suppliers are not willing to give us any credit period. So we need to pay them at the spot itself. But we don't have money. What we'll do? We will be they will be approaching a bank to get a working capital facility for this 120 days period. This is a this working capital loan is provided for meeting the shortage of fund during this working capital cycle. So what we are funding here, we are funding only the difference between current asset and current liability, or simply difference between the funding requirement will be computed based on debtors, stock, and creditors, because creditors gives us credit period. So means we can delay the payment of creditors based upon the credit period that they give, and we get the money from the customers based on the credit period we give to them. So when we give more credit period to them, the money inflow will lag. Similarly, when they give less credit period to us, when the suppliers give less credit period to us, there we need to pay more earlier. So the fund shortage will be there. To compute fund shortage, we'll be having three methods. That is method one, method two, method three. Method one is 75. We are 75% of current asset minus current liability other than bank borrowing. Current asset includes debtors plus stock plus other current assets. But most important current asset will be debtors and stock. Current liabilities includes creditors. So we'll be funding 75. Why we can fund 100%? We can fund 100%, because the current asset minus current liability is the shortage of fund they have. So why we cannot fund 100%? We assume that promoter should contribute at least 25%. So the remaining 75% is what we fund. That is method one. So balance 25% promoters have to contribute, or they can contribute using other long-term sources also. So the formula will be 75% of current asset minus current liability other than bank borrowing. Balance 25% from long-term sources. A minimum current ratio should be worked out at 1.1 times. This is method one. Method two. Method two is 75% of current asset minus current liability other than bank borrowing. Here, difference is method one is we are this working capital gap is current asset minus current liability. On that, we are funding 75%. That is the method one. Method two is we are funding 75% of current asset minus total current liability. Means we are funding only current asset 75% reduced by the current liability. So here we are funding. So we are should ensure that there is proper current asset in the book, and on that current asset only we will find 75%. So 25% of current asset should be contributed by the promoter. Here borrower should raise finance to extend 25% of current asset. So here, as per this formula, minimum current asset requirement, current ratio will be, sorry, it's wrongly mentioned. Current ratio is 1.33 times. The method number three, or tandem method number three, this method is normally not followed much of the banks. This is 75% of current asset minus core current asset minus current liability other than bank borrowing. You need to understand what is core current asset. So there are certain current asset is required for business to function. These are permanent current asset. These are like current asset, even though they are known as current asset, this is like permanent current asset. They are long-term current assets. So we need to reduce that current asset. This it may be these are basic current asset that is required for the business. So we cannot fund that. We can fund only those current assets which are required for production, that is required currently. Means current asset that is required for the existence and running. What do you call this? Is throughout the existence there will be some current asset that we are not going to fund, that promoter has to bring, and the remaining current asset we will be funding 75%. That is how this method is computed. So 75% of current asset minus core current asset minus current liability other than bank borrowing. Types of working capital facility. There are different types of working capital facility. We will be going through each of these facilities one by one. One is cash credit or overdraft. Cash credit is a demand loan, and interest is payable on actual amount drawn. So suppose we utilize a cash credit, we will give, so suppose 5 crore. In that they utilize only 3 crore. So we will be computing interest on 3 crore only, not the entire limit. That is what is I mean by interest is payable on actual amount drawn. So they will have facility, they have the ability to draw up to 5 crore, but it is their option to draw whatever amount that they require. That is a major advantage of cash credit facility and overdraft. So there are two items. One is cash credit and one is overdraft. What is the difference between these two? In overdraft, it is like amount is fixed. We will not checking a drawing power. What is drawing power? Drawing power is computed on a regular basis based upon the stock debtors and creditors level. So every bank will have a minimum what you call. Every bank will compute this drawing power monthly or what you call periodically, and based on that they will give a facility. They will fix the drawing power. They will, and we'll tell that you should not draw beyond that. It can be lesser than the limit or it can be equal to the limit. So that is a so that is applicable only when it is cash credit. For overdraft, this drawing power won't be computed. So that is makes the difference between cash credit and overdraft. Next one is bill discounting. Bill discounting. What is bill discounting? It's like I suppose I'm a here in this case I am a supplier of goods. I supply goods to Mr. X. In that situation, Mr. X gave me a bill. In that this bill I can discount in the bank. It's as simple as bill discounting. Bill discounting is submitting a bill to the bank. Supplier will what it calls customers may take more time for realization. They will not pay at the right time. Means they will give them more time. We may give them 1 month, 2 months, etc. In the situation, they will give a bill. This bill can be bill of exchange as per Negotiable Instruments Act. This bill can be discounted in the bank. This when a bill is discounted in the bank will reduce a discounting charge. This discounting charge is nothing but the interest during this period of realization. So bank technically gives us a loan based upon the bill, and bank will realize this amount from the customer. So will the bank discount all the bills? No. Bank will discount only those bills where creditworthiness of the customer is there. So maybe bank will allow this bill discounting to some genuine customers. So that is a credit appraisal done by bank on the customers. So that is what is bill discounting. Next one is packing credit. What is packing credit? Packing credit. Suppose I am an exporter. I manufacture goods and export. Normal export takes a lot of time. It takes time for transit. Then after that takes time for realization. So I need fund. For this, bank provides two types of facilities. One is pre-shipment facility and one is post-shipment facility. What is pre-shipment facility? It is advance given to exporter for financing, purchase, processing, manufacturing, or packing of goods. Here, suppose during manufacturing we need to pay salary to employees. We need to procure raw materials from domestic sources as well as from international sources. For all of them, we need fund. This is met through free pre-shipment facility. This pre-shipment facility is used for manufacturing and up to the sale of goods. Post-shipment is advance given for realization of export. Means advance given to export after shipment of goods. After shipment of goods, what do you call this advance is known as post-shipment. Technically, whatever pre-shipment facility is there, that will become post-shipment after the export is done. So it's advance given to exporter after shipment of goods to the day of realization of export proceeds. So that is a major difference between post-shipment and pre-shipment. This pre-shipment may be received in the form of domestic currency or international currency because we may have to pay salary. In that salary, we can pay only to the local employees in domestic currency. Similarly, We may have to purchase materials from abroad. In this situation, we will be providing and we'll be getting this facility in foreign currency also. So pre-shipment can be in domestic currency and foreign currency. So this is basic idea about packing credit. Packing credit is given only to exporters. When company sell goods to abroad, then we give packing credit. Factoring. What is factoring? Factoring is a type of debtor financing. I'll give an example. I'm a company. I have five debtors. Normally, I can wait for realization. Now I thought, why I should wait for realization? I can sell this debtors. I can sell the debtors as per the Indian laws. What I'll do, I'll go to a factoring company, sell the debtors. They will give us money after reducing discount cost or after reducing the interest time, means the interest for the time period of realization. And they will also reduce some extra, and that interest rate will be higher. Why? Because it is now the responsibility of factoring company to realize the money from the customer or from the debtors. So there are three parties involved in factoring. Factor, a person who purchases receivables, means a company who purchases receivables. This is known as factor. Seller of receivable. Here in this situation, I am the seller. I sell the receivables. I sell the debtors to this factoring company. And the external debtors who has financial ability to owner. This person should pay earlier to me. Now they need to pay to the factoring company. So this factoring is nothing but sale of receivables to a factoring company. Demand loan. By the name it says it is a loan where repayment is required when the bank demands the money. It can be complete demand or partial demand. It is when bank demands the money, then we need to give the money back. Maybe the banks may give a time, what do you call, after demand by the bank, they may give some time, say 1 day, 2 day. That based on that, we need to give the money back. So demand loan is risky because we are obliged to repay when the bank demands. Term loan. Term loan is a long-term loan. So it will be we have to pay them on a fixed term. There will be repayment schedule. Repayment schedule will be clearly telling on what all days we need to repay the loan. It can be say like from 1 year to 10 years or even higher. It can be even 20 years. If it is a project loan, very long period loan can be also given. It is normally secured in nature. We'll be taking collateral, and based on that only we'll be providing. It is of course bank's call. Bank can decide whether it can be secure or unsecured, but normally secure. Security can be mobile security, immobile asset, like it can be plant and machinery, land, building, share, whatever it is. That is bank's call. So term loan is a long-term loan with fixed repayment schedule. Project infrastructure loan. This project infrastructure loan, this is for maybe for construction of roads, construction of big, what do you call, various infrastructures to fund long-term infrastructure, industrial projects, and public services, in which project debt and equity is used or paid to cash flow, payback from cash flow generated. So in this situation, it is a long-term, say tenure of 15 to 20 years. It's a very long-term project. It can be here funding will not be done purely by the banks. It can be done by various financial institutions. Mutual funds will be funding it. Angel investors will be funding it. It based on equity will be banks and financial institution. Banks, financial institution, along with equity investors, will be funding for a particular project. And for this particular purpose, maybe separate a company will be formed. We call them a special purpose vehicle. It's nothing but a company created by a normal company set with funding from this particular equity investors and backed by banks and financial institutions. Microfinance loan. This is normally given to small businesses. Mm, Here, it's a recently Bangladesh microfinance loan was one of reason by one economist in Bangladesh got Nobel Prize. This is This is for supporting small businesses who lack access to banking and related services. Here, it's like mostly like a cooperative society where funding will be provided to the first, small business based on the requirements. It is a successful model followed in self-help groups and other means, especially in Kerala, we have Kurumbashree, they provide microfinance loans. These are well successful system where many small enterprises are getting funded. Real estate construction loan. This is a just like this is a term loan. So it is provided developers and builders, and very large ticket size and tenure will be very high. Agricultural and allied loans. As well, it is given to farmers for purchase of equipments, tractors, harvesters. This is a facility given to farmers for their long-term assets. So it will be secured against the underlying asset. For example, if they're purchasing tractors, tractors will be the collateral. So mostly tenants will match with the underlying asset. So tractor's life is 5 years. We'll be providing facility for 5 years. Tractor's life will be more than 5 years, of course. If it is 10 years, then the tenor also will be 10 years only. Now let's go to non-fund based facility. Non-fund based facility, one of them is bank guarantee. It's one of the most important non-fund based facility. I can explain what is bank guarantee through an example. I have already explained what is bank guarantee. I just told bank guarantee is a guarantee given to a person in bank will repay only if that person fails. So if a bank gives bank guarantee to Mr. X on behalf of Mr. Y, Mr. Bank will have no responsibility till Mr. X obliged. But Mr. X, if Mr. X fails to apply, then bank will be obliged to pay to Mr. Y. Let's look at this example. In this, NHAI is National Highway Authority of India. NHAI will give various tenders. They will be, for example, they need to construct a highway. NHAI want to construct a highway. They invited quotations from various contractors. Mr. A is a contractor. He quoted. One of the major issues of NHAI is Mr. NHAI does not know Mr. A. He doesn't know, NHAI doesn't believe Mr. A will be able to comply the project requirements. So what they'll do, NHAI demanded a security deposit. Problem is Mr. A, if they give security deposit, that will impact the working capital requirement. They will not, that fund will get reduced. So Mr. A told, I will not give security deposit. I will give a guarantee. I'll give a guarantee from a bank. And HI told, okay, that is fine. So what Mr. A will do? Mr. A will approach a bank, get a bank guarantee, and give this to NHAI. So this is the basic process. So say it simply, bank guarantee is a guarantee given to a party where bank is obliged to meet the guarantee requirement when the party fails to meet the obligation. Letter of credit. This is normally used in case of export trades or import trade because when I sell goods to Mr. say like Mr. X in abroad, I don't know Mr. I may not be knowing Mr. X in abroad. Even if I know, it is very difficult for me to recover from a foreign country. So this letter of credit is instituted to ensure that the transactions, I mean, foreign transactions are more transparent in nature. So, it is that when I tell letter of credit is mostly used for export trades only, it doesn't mean that it is used only for export trade. It means letter of credit can be used for domestic trade also. So letter of credit is used in normally international trade, used when exporters and importers are known to each other. So bank undertakes to pay when importer fails to pay. So when I export some material to Mr. X in USA, if Mr. X fails to repay, then the bank in that country agrees to repay me. That is what is meant by letter of credit. So this is a brief illustration of how letter of credit works. A. See, you should see A. In A, in Mr. Here, Mr. X is exporter, Mr. Y is importer. So Mr. X want to wait. Yeah. Here, Mr. X is exporter, Mr. Y is importer. Mr. X want to sorry, a mistake. Here, this opposite. Sorry, Mr. Mr. Y is exporter. Mr. Y sell goods to Mr. X. So what they do? Mr. Y sell goods, but before delivering goods, Mr. Y want a confirmation, like a bank guarantee from Mr. X, saying that if Mr. X fails, then bank in India should repay money to me. So one of the trusted banks in India will be giving a letter of credit, so that Mr. X will be get comfort. That is known as letter of credit. Here, letter of credit is like bank guarantee, where they take a confirmation or a letter from a bank from an importing country saying that they will repay the amount in case the party fails. So the process is Mr. Y sells goods to Mr. X and they deliver goods only after getting a letter of credit from an Indian bank. Classification of assets. This I will take on next lecture. So I hope this lecture will be useful to you. If you like, please like this video, subscribe and share. Thank you.